So the whole feeling around Bitcoin, around digital assets, it's just fundamentally changed.
Mm,
For years, the official line from, Washington and Wall Street was basically skepticism at best.
right. Or outright hostility. Warnings, stay
Yeah.
away.
Exactly. But now it seems like, well, almost overnight, the regulators who govern the biggest banks in the US have quietly just given them the green light.
They have.
The entire financial establishment can now, just jump headfirst into crypto.
It's more than just a shift, I think.
Yeah.
It's a complete 180. We are watching a sea change where the very institutions that saw Bitcoin as this existential threat are now baking it right into their core business.
Okay, so the critical question for you listening isn't if they're adopting it.
No. It's why they're doing it now so suddenly and what that really means for an individual investor, for you.
That's our mission for this deep dive. We've gone through a stack of analysis on these recent, massive regulatory announcements. Specifically, we're looking at a key release from the Office of the Controller of Currency, the OCC, from December 9th.
And the tsunami of bank activity that came right after.
Yeah. We need to decode what this pivot is really about, understand the structure they're using, and maybe most importantly, identify the catch,
There's always a catch.
the thing that could cost you your financial sovereignty.
Our goal here is to unpack that duality. Is this a sign that the decentralized revolution has won, or is this just Wall Street finally figuring out how to, slap a fee on the revolution and sell it back to you?
Let's start with the mechanism, the actual regulatory change that opened the floodgates.
Okay, so the foundational piece.
Okay.
It all comes down to that OCC letter you mentioned. It confirms that national banks, we're talking the heavy hitters here, can now act as crypto intermediaries.
Which is massive,
It is, because it gets around this huge historical problem they had.
which was the risk, right?
The risk, exactly. The critical detail here, the part the banks just love, is that they can now buy and sell Bitcoin for their clients without having to hold it on their own books.
Wait, hold on. If they aren't holding it, how are they facilitating trades? If they're moving millions of dollars of crypto, surely there's some risk there.
Well, this is the clever part. They're doing it as what's called a riskless principle.
Okay.
So imagine the bank isn't a warehouse for Bitcoin. They're more like a, a hyper-efficient digital broker.
Yeah.
They match a buyer and a seller at the exact same moment.
So the trade is fulfilled instantly.
Instantly. The bank is never exposed to the volatility of holding the asset. There's no inventory risk, so it sidesteps all those classic balance sheet problems.
So the regulators are basically saying, look, you can make money from the trading, from the fees, but you don't have to carry the volatile asset risk, which keeps them in that safely and soundly box.
It's a genius regulatory workaround. For years, banks were terrified that if they touched Bitcoin, regulators would just hammer them with impossible capital reserve requirements. But by doing this, the OCC has essentially endorsed Bitcoin not just as a commodity, but as legitimate foundational digital capital.
And that endorsement is the prerequisite for everything else we're about to talk about.
Everything.
Okay, so this new framework, it comes with rules. It's not the Wild West. The regulators are calling it a limited pilot program with important guardrails.
That's right. And the structure is very specific. This program uses registered CFTC brokers, known as Futures Commission Merchants, or FCMs.
So they're using an existing regulated infrastructure, not building from scratch.
Exactly. These firms are already overseen by the CFTC and the National Futures Association, which is sort of like FINRA, but for futures. So there are rules.
And what about the most complex guardrail? I was reading about the collateral rules.
This is where they really isolate the risk. Participants in this pilot, they can use assets like Bitcoin, Ether, and USDC to collateralize contracts.
Yeah.
But, and this is the key, the collateral must be in kind.
In kind. Okay, what does that mean in, plain English?
Yeah, good question. Think of it this way. The regulators are saying you can use your Bitcoin as collateral, but only to secure a debt that's also denominated in Bitcoin.
So apples for apples.
Exactly. If the contract is settled in Bitcoin, you use Bitcoin collateral. If it's settled in US dollars, you have to use US dollars. You cannot use a volatile digital asset to back a traditional cash debt.
That makes perfect sense. They're basically forcing the crypto market to be self-contained at first. It limits the systemic risk while they test how this all works.
Precisely. And they are watching this like a hawk. For 3 months, there's enhanced CFTC monitoring. This means weekly reports on positions, asset classes. They have to report any significant operational issues.
So the stated goal is just to gather data and understand the tech in a controlled environment.
That's the official line.
Okay, so that's the cause. The lane has been built. But this is where the story gets really wild for me. The institutional effect, the
Right.
speed of this change. It's just shocking.
It is.
Analysts were predicting a slow creep, right? 4 to 8 years. What we're seeing is more like 4 to 8 months.
That speed tells you everything you need to know. Just 12 months ago, the consensus from major banks was hostile, negative, or, deeply skeptical. Now, that same group has flipped.
It's not an evolution. They panicked into it once the door was open.
The velocity is.
Yeah.
It's undeniable. One analysis we looked at quoted Michael Saylor on this. He pointed out that a year ago, 0 of the top 10 U.S. banks were issuing credit against Bitcoin.
And now?
Recently, that number jumped to 6 of the top 10.
Mm-hmm.
And then an updated report said 8 of the top 10 banks are now actively in the game.
8 out of 10. We're talking JP Morgan, BNY Mellon, Citibank, Wells Fargo, all reversing their public stance and launching services almost in lockstep. It's not evolution, it's a gold rush.
A total gold rush.
Sure.
And we have concrete examples. BNY Mellon, Wells Fargo, Bank of America, Schwab, JP Morgan, Citi, PNC Bank, Vanguard.
All of them have made announcements.
And they're not just issuing credit, they're building the core infrastructure. I remember Schwab is set to custody Bitcoin and extend credit against it early next year. Citi is doing the same. Think about that. It used to be impossible to get a loan against Bitcoin from a major bank. Now it's becoming normalized. It signals that the establishment now views this as a dependable asset.
And that dependability, that's the motive.
Yeah.
So if the regulatory hurdles are gone and the banks are pivoting this hard, we have to ask the big question. Why are they bending the knee?
The analysis we reviewed proposes a very simple, very powerful answer.
Yeah.
An opportunity for just extraordinary profit.
But driven by a new financial thesis.
A new thesis, exactly. The banks have concluded that Bitcoin has become the global digital capital base of the entire crypto economy.
Yeah.
And once you accept that premise, well, what's the next logical step for a bank?
You lend against that capital.
You issue credit against it.
Explain this digital credit concept. The sources say this is the killer app they're all chasing.
Well, think about history, right? For centuries, the world's financial system ran on credit issued against gold. Banks stored the gold, they issued paper IOUs, and they lent out far more than they actually held. The digital version is similar, but as the argument goes, superior. Bitcoin treasury companies, or now the banks acting in that role, are issuing credit against this new digital capital base.
But is it actually better than conventional credit? Or is that just hype?
The analysis argues it is demonstrably better for the lender. The core idea is that digital credit issued against something like Bitcoin is superior to all conventional credit.
Why?
Because conventional credit is built on depreciating collateral. Think of a loan against a data center or a warehouse or equipment. That stuff loses value over time.
Okay, right.
But with Bitcoin, the collateral isn't just digital and instantly verifiable.
Yeah.
Historically, it's been an appreciating asset.
So if a bank lends against a warehouse and the real estate market crashes, the bank loses.
They lose. But if a bank lends against Bitcoin and the value of that collateral trends upward, they have a massive built-in hedge. It makes digital credit a much more stable and profitable base for their lending business.
So it's a twofer. They benefit from the asset's potential built-in yield through appreciation, and they found a second revenue stream, this gold mine of selling access through ETFs, custody services, you name it.
Charging fees and taking spreads on every single transaction. It's a hugely lucrative, two-sided business that removes the regulatory risk and opens up massive profit potential.
Okay, so this brings us to what I think is the most crucial part of this for anyone listening. We get the regulatory shift, we get the profit motive, but what does this new world of bank-provided access mean for the individual?
The analysis here is crystal clear. This convenience, it comes with a profound and often hidden catch.
We need to look at a specific example, like PNC Bank.
Right, so PNC announced they're letting qualified clients, and you should read that as high net worth, already rich clients, buy actual spot Bitcoin right from their banking app. They're framing it as, no need to use a separate crypto exchange.
Which, to be fair, sounds incredibly convenient, especially for someone who's maybe a little less tech-savvy. But the analysis points out two huge problems here.
First, the access is restricted. It's only for the rich. And second, and this is the big one, the service itself is just a rebranded exchange inside their own walled garden.
What's the critical distinction there?
When you buy Bitcoin through PNC, or any custodial bank service, You are just using their interface. You never actually touch or control the private keys.
The bank holds the keys. You just hold an IOU.
You hold an IOU. Exactly.
So what's the real difference between doing that and just buying Bitcoin on, say, Coinbase, and then moving it to my own wallet?
The difference is everything. It's self-sovereignty versus custodial dependence. Anyone can go buy real Bitcoin sats on an exchange right now and immediately withdraw it to a hardware wallet that only they control.
No intermediary necessary.
Zero. The banking system is profiting by taking advantage of user inertia, the unwillingness to spend an hour learning how to use a wallet. And for that convenience, they charge you fees forever while they hold the actual keys.
And if they hold the keys, they hold the control.
Absolutely. The true superpower of Bitcoin isn't the price going up. It's the ability to be your own bank. It's about resisting that third party, whether it's a bank, a government, whoever, from controlling your wealth.
So this whole pivot is a kind of psychological game. They're reinforcing the idea that, oh, this is too complicated, or it's only safe if you let the professionals handle it.
And the second you agree to that, you are subject to their rules, their fees, their limitations.
It doesn't matter if the asset is digital or not at that point.
Doesn't matter at all. You are paying for permission to access your own money. And the whole point of Bitcoin is permissionless access. The core advice from these sources is very clear. Buy real sats, withdraw them to a secure hardware wallet, learn how to protect your seed phrase, and move a portion of your savings into your own custody.
And crucially, never leave it all on an exchange or with a bank, because you're still just trusting a third party. When you take custody, you have a level of financial independence that not even PNC's richest client truly has.
Because the moment the system freezes or a decision is made that you don't like, the bank decides if you get your money. With self-custody, you are the only one who makes that decision.
Which brings us back to this incredible duality. The OCC letter, the moves by PNC, these are huge dominoes. This signals that the old 4-year cycles might be over, and we could be in for a much deeper, longer wave of adoption.
But that acceleration forces us to face that critical question. Are banks becoming benevolent Bitcoin on-ramp providers? Or are they just the same old opportunistic bloodsuckers finding a new way to profit off a peaceful revolution?
The answer seems to be both. It depends entirely on how you decide to participate.
Exactly.
And that leads us to the final and I think most provocative thought that the source material leaves you with. We're always told that in a real financial crisis, the system can and will lock you out of your own bank account.
You'll be asked to trust the system while your funds are just inaccessible. The analysts advocate for true diversification. Yes, keep cash, but also own self-custodied Bitcoin.
Because when the traditional system freezes, for whatever reason, the people who planned ahead will be the only ones whose capital is still moving. While everyone else is waiting for permission to touch their money, you already have yours.
Understanding that the world's biggest banks now treat Bitcoin as digital capital is an endorsement you just can't ignore. So what steps does that realization suggest you should take right now to make sure your capital, digital or otherwise, remains truly yours and yours alone? That's the real deep dive worth taking.